Welcome back, everyone, to another episode of Ready, Aim, Retire, the show where we talk about your investment plan, your insurance plan, your legacy plan, and kind of everything retirement-centric. I'm Rob Kirvan, as usual, and I am here with Mr. Tony Shore up in the great state of Minneapolis. Tony, just so you know, you've been on the show. You probably watch us a lot. This is one of those shows where Tony's had a lot of coffee. He just showed me a container this high. There it is. There it is. So we're probably going to have a good one today.
Oh,
Tony, he'll get the sound effects going, the life going.
Oh yeah. Yeah. I've had the full 8. I got the full 8 last night, which means, the full 8 hours of sleep. And when I get the full 8, we're on fire. And then I had a free coffee coming on my coffee card today. So I'm ready to go.
So you got a free gallon, it looks like.
Yeah.
That's kind of how that works.
At least a liter.
Right. Yeah.
It's a liter of espresso. Is that wrong? Is that wrong? I bet you didn't even know Tim Hortons sold liters, did you?
I didn't. I
Or
know they sell
Starbucks.
doubles. I'm not a coffee drinker, but
Yeah.
I live in a house of them, so I see a lot of those things come around. But
I'm sure you do.
I've never had what you're holding, Tony. I can tell you that.
Yeah.
But,
all right. So, Rob, what have you been up to lately? Has it been busy there? I mean, this is kind of a busy time of year.
It's been busy. I just got back. I was away watching my daughter golf. She was down in just outside of Las Vegas.
Oh,
so
wow.
I was there for 4 days. Actually, while I was there, Tony, I've been to Vegas probably in my life 30 plus times. I've never been to a show. I've never been to a Vegas show like whatsoever. Like I've gone for dinners, but a lot of times it's like conventions and things like this, right?
Yeah.
So
I never go without taking in at least one big show.
Have you ever been to Cirque du Soleil?
Yep.
Yeah.
I've been to the Beatles Love. Which one?
Michael Jackson.
Oh, wow.
And if you saw Natalie, the way she dressed for this, she looked like Michael. She looked like a little miniature Michael.
That's funny.
Probably the same size. I think it wasn't a big guy. So probably the same size. Had the shirt, had a golf glove on.
My God.
Yeah, no, she was into it. I look like a loser. I was just wearing regular pants and a hoodie.
Sure.
I was just like, I didn't know it was a dress-up party. But
I wouldn't go dressed as Michael Jackson, but Nat can pull it off. She can get away with it, right?
Yeah, she was ready to rock. She got a lot of looks, and so it was pretty good.
That's awesome.
And I got back, but yeah, it has been busy. It's tax time, so people calling for 1099s and things like that. And everyone's trying to get that buttoned up because the quicker you get that done, the quicker you move on with the rest of your year, right? So, so it has been pretty busy.
Yeah, well, that's good. Now, obviously, nothing's been going on in the financial world the last week. I mean, there's no news.
I didn't even know what we're going to do the show on.
Right?
There's nothing going on. Like usually, I like a talking point or two, Tony. If there's something, anything, give it something.
But. Yeah, well, I thought you were going to say, Tony, how are you doing? And I was going to say, well, I've had a better week than the stock markets have. Let's put it that way.
I think most have, really. If you're live and listen to the show, you're definitely having a better week than the market.
Well, and I know some people
in the market too, I would say.
Yeah, some people let the news and the market volatility and the tariff talk. They let that get to them and they get emotional. In fact, I've got a soundbite for us today.
Okay.
Buckle up, Buttercup.
In times like this, Tony, you really got to you just got to put the seatbelt on a little tighter. Yeah, you got to put a seatbelt on a little tighter.
Buckle up, Buttercup. That's what we're telling people.
I like that.
Yeah, bring an umbrella. Right? Those are phrases that I've heard this week. Buckle up, bring an umbrella, but don't panic, right? In the immortal words of the English author Douglas Adams, don't panic, right?
I would say I would say, panic, and we've done shows on this, Tony, like when market's correct. We've done shows of, panic isn't an investment strategy. We've done that show. Right. And today we're going to talk about, I want to more focus today on emotions. But let me give you, I have just a little, 5-pointer stat pack of what's going on out there. And this is where people, one of these points maybe doesn't throw somebody off, but coupled together one after the other, emotions all of a sudden can play a big role in making bad decisions. So as Tony mentioned, markets, they're in correction territory. The S&P down over 10% from its all-time highs, Dow down 9%, NASDAQ, the tech sector, down 14. Depending on what you're owning in that tech sector, you could be down 30 or 40 with some of these holdings. We needed this correction, first and foremost. Despite it coming, on the heels of, there's tariffs and things like this, this has to happen in an efficient market. If you don't have at least a 10% pullback every 18 to 24 months, you build a bubble, and you don't want to build a bubble. We've been through those. So instead of going down, if this one ends up being a 10 or 12 or 14% pullback, I'd much rather that than a 25 or 30 or, think like COVID,
well, sure,
down 36%, so
yeah,
we don't want to do that. And we do anticipate over the coming months, we've had a few phone calls, and thank goodness we meet with our clients, and I think we give them enough information all the time, maybe sometimes too much information, that we don't get bombarded in phone calls. Like I had a client call me saying, "Oh, you must be getting a lot of calls." No, guess what? You're the first. Maybe I had 2 emails and a phone call, but because everybody knows that they have a plan with a purpose, they know what the long-term objective is, and if you have a long-term, outlook, you don't get caught up in these short-term, wobbles, right? So I think it's still going to be choppy for the next several months.
Yeah.
We may come off of where we are, get up a little bit. Everyone feels like warm and fuzzy, and then it's going to, probably dip back down. We kind of have to get on the other side of this tariff talk, so that, like anything else though, Tony, it will pass. This is not something that stays around for, a year or 2 years. They will negotiate these things out. However that ends up, it ends up. And then once you have a starting ground, and kind of, this is what we're dealing with. I have clients in several industries. I have one in the steel business that, the tariff is one thing on Monday, one thing on Wednesday, and it's kind of turning his business upside down. So he certainly wants just to get on the other side. Like once you know the number, you know the number.
Yeah, it's the uncertainty that's causing the problems. I mean, back in the first Trump administration, Trump put into effect additional tariffs on China.
Yep.
And, we might have seen a slight market activity at that time because of that, but it was certain. He did it. It continued. In fact, Biden was going to increase it. I don't think it ever happened, but Biden kept it in place and was going to increase it. And I think we're all on the same page with China. I think that we need to get that balanced out because it was really imbalanced.
Yeah, it's it's very one-sided.
It was a one-sided deal. I think what threw people off a lot is the Canada-Mexico thing, because there are other 2 biggest trading partners. China was number 1, but now they're number 2. Mexico's 1. Canada is third. China's still number 2. But I think it's the uncertainty. It's the wishy-washy. 1 minute it's on, 1 minute it's off. 1 minute it's 25%. The next minute I read 100% tariffs now on EU things like champagne. So Rob, send the kids out to buy champagne before it goes up.
You don't want to get too pricey, And thank goodness I'm not a big champagne drinker, but it's right. Like I'm from Canada, originally. So I have lots of friends and, people I played hockey with and stuff up there that are, I'm getting a lot of texts.
I bet you are from them, not from your clients, but your old friends up in Canada, friends and family.
More texts from like friends that did, barely text me of like, what's going on down there, that kind of stuff. But again, all of that is white noise. It's all going to pass. And you can't make a decision based on these short-term things that will iron themselves out, and we'll get on the other side of it.
Yeah, we should have called the show "This Too Shall Pass."
This too shall pass. Well, we could change them. We're allowed to do that.
That's good.
Or is it too late?
No, I like your name better.
Okay.
Emotions can kill your portfolio.
Oh, that's true. That's true. Another note, Tony, inflation came in lower than expected. It came in at 2.8% year over year.
Yeah. It's a good economic indicator.
The price of eggs dropped. I don't know, so they were getting pricey. Natalie wouldn't let us buy eggs in the house until it got to like her price point. So I'm thinking maybe this weekend she's going to buy a half a dozen. She probably won't go for a dozen because we're not going to just spend money frivolously, but like maybe a half a dozen little starter pack, and then get back onto where eggs used to be.
We never stopped buying eggs. We never stopped. Our family loves eggs too much.
I love them too, but Natalie says no.
Yeah.
It's
she's the boss. She's
the boss. Yeah, I'm just a worker. Next up, Tony, we've seen the 10-year treasury. This one's important. So the 10-year treasury is basically the benchmark for everything lending. mortgages, car loans, credit card interest rates. And we've seen the housing market have a very tough time over the past, 24 months, like a very tough time.
Yeah, for sure.
Because the mortgage rates were at 7%. Well, we've seen the 10-year treasury drop from 4.9 down. It's currently right around 4.3, but I've seen it as low as 4.2. And subsequently, we've seen the mortgage rates drop from 7% to low sixes. I even saw a 5.95. So if we can get those in the fives, real estate will start rocking and rolling again. And I have several clients that want to get on the move. They're not going to trade a 4% mortgage for a 7, but they may trade a 4 for a 5.
Right.
And we might see people doing that. So that's pretty positive. The other thing we've seen that's positive during this time of turmoil is the price of oil has dropped 15%. So you go to the pump now, we've seen the prices come down. I don't know in Minneapolis, but certainly here we have anyway.
Yeah, we've seen it too.
Yeah. So those are 5 things that are kind of going along. So if someone's head can get kind of a little spinny, the oil's down, but this is up, or this is up. My account's down, or you can get caught up in it, whatever minutia you feel like getting caught up in. Go in Facebook and type something in, and you will get everything you need fired at you forever. Go to YouTube. Go to and I have a good client that he tends to get caught up in the sky's falling kind of stuff.
Yeah.
And so his feed, he's I don't have TikTok, but he has TikTok. So he's like, oh, I heard this. I'm like, it knows what you want to hear. Like that's what these things are designed to do. So if you think the sky's falling, it will throw everything at you that the sky is falling. If you think everything's going to be awesome, it will throw stuff that's awesome. So, you might want to flip your algorithm around if you're getting too much of one side or the other side. But at the end of the day, block out the noise, and individual investors sitting on an island by themselves without getting help from anybody. These are the times that they have a particularly tough time. And what I'm going to ask you to do, Tony, pull up that first chart I sent you. So folks, we have 2 charts coming up that I think are really, really, really important. So the first one is the impact of time out of the market. All right. So here's a scenario, Tony. Let's say things are getting choppy, right? You're afraid of the tariffs. You think like everything's going to go sideways. This is going to happen. This is going to happen. And you can build up whatever you want in your head, and think this is the worst thing on that's ever happened. We've been through multiple. This is a minor correction currently. But if you took your money and you said, what might be a good idea, I'm just going to sit this one out for a little bit. I'm going to take my money. I'm going to put it in cash, and I'm going to wait for everything to pass and get on the other side of it, right? And you might say, okay, well, that seems kind of logical. If you look at the chart, folks, there, if you don't do anything, if you just you rely on us, obviously we make changes to portfolios, but as far as we're always invested, and if you just stayed invested in the S&P 500, and this is the 20-year time period from 2002 to 2021, that's where all these charts are coming from. Those are the most recent that they have. You would average 9.52%, like in fully S&P 500. A lot of our clients aren't fully S&P 500, as you would understand,
Sure.
really balance and things like that. But this gives perspective. But if I only missed, this is in a 20-year time period, Tony, the 10 best days.
Out of 20 years.
In 20 years, the 10 best days, I took my money out, put it to the sidelines because I was nervous. Now, maybe this is the time. Maybe it was the time before. Maybe it was during COVID. Maybe it was during, the financial crisis. Whenever you happen to do that, if you miss the 10 best days, your return dropped from 9.52% annualized to 5.33.
So half. You cut it in half.
Almost in 10 days. 10 days in 20 years. What are you talking? You're talking 7,200 plus days. You missed 10 of them, because you had a little panic in the system. Your emotions got the best of you. And individual investors, the ones that manage their accounts, not all of them. If you're out there listening, I don't do it like that. Fine, I got you. But I'll show you the next chart after we finish with this one that shows you kind of how they do. And this is their problem. This is the actual underlying problem. So if you miss the best 20 days in those 7,000 plus days, you actually drop all the way down to 2.63%. So you said, I'm going to sit this thing out for 4 months. And in those 4 months, and you do this multiple times because that's kind of a pattern thing. People panic. You miss 20 days. 20 days, you're down to 263. 30 days, you miss a month of markets, you're down to 0.43. So you're basically even Steven for 20 years, Tony. You've invested your money for 20 years. You missed the best 30 days, because what happens in these markets is just like something can go down. The NASDAQ the other day was down 4%. If it can go down 4 in a day, Tony, guess what? It can go up 4 in a day.
Yeah. Or it could go up 8 in a day. I mean, it could happen.
Oh,
so
100%.
In fact, when the market, usually when we're saying you miss the best days, people think, well, I'm probably not going to miss the best days. I'll get back in and hit those. If the market tanks, that's when people panic and pull out. So they've sold low, and then they're going to wait because there's market volatility, but they miss that. The growth can sometimes happen. And what if they miss the best days? Usually some of those days, at least, are anywhere between a week and a year from there, because it just goes right back up.
Usually market slingshot, once it gets oversold, you'll see days coming up, and I don't know, I'm definitely not saying this is the bottom where we're at, Tony, but there's been a lot of damage done, over this. It's only been 3 weeks, and it's been a very aggressive drawdown, right? So odds are we're going to get some sort of relief rally. We'll get something where one of these days is definitely going to be in the mix. And probably what's going to happen, it's going to get to a level, it's probably going to correct down again, because it usually don't just come out of the chute like this. It usually gets up, it's got to come back down, it's got to test that number, whatever that number is, that's a piece of 56 and change. It's got to test that number and then off to the races, right? And going through, I won't hit every single one of these, folks. You can see them on the screen. But what if you miss the best 60 days in 20 years? So you get 7,000 days, you miss 60 of them. Your return is actually negative 4.85%. So in 20-year period, you actually run a negative return. And I see people bring their portfolios in that manage them themselves, and I'm thinking, hey, this guy's probably doing pretty good because I see some of the holdings, but these are recent buys, or whatever they may be, and they're not. Their average over time is terrible. And the reason is because they have emotion. When we managed accounts and we use Gradient Investments as our investment team that manages all the different strategies, 30 plus different strategies that we utilize, there is no emotion. It's not their money, Tony. When it's not your money, you make smarter decisions because it's based on fundamentals, it's based on technicals, it's based on forecasts, it's based on earnings, cash flow, the things it's supposed to be based on. Whereas an individual, their account goes down, especially these high flyers that people made a lot of money on, whether it's Palantir or Tesla or these plays. Tesla's down 40% year to date. Do you sell it now? Is this a good time to sell it? These are the decisions that an individual that's out there on an island, has a very hard time with. Whereas when you use professionals, they've seen that, been there, done that. They've been around for 30, 40 years. This is all they do all day, every day. So we always stay fully invested. I can't remember a time where we didn't. And if anything, after COVID, we actually invested more. We took bond funds and invested more, to take advantage of the bounce. But this is a very impactful slide, to kind of show you time in the market. It's not trying to time the market, Tony. It's the time that you stay in the market, and staying fully invested always pays off. Now let's talk about the individual investor, Tony. Why don't you switch to the next slide?
Sure.
So the individual investor, like I just said, they let their emotions get the better of them. And this slide will show you that I've highlighted in orange there. So let's go through some of the returns, because this is on podcast too. So not everybody's looking at this chart. So this is, again, the exact same time period I just showed on the other slide. So this is from JP Morgan, 20-year annualized returns, 2002 to 2021. So if we look at the S&P 500, same as the other charts, at 9.5% annualized over that period of time. If I go down and go, okay, this a 60-40 portfolio, that would be, a lot of our clients would have something like that. You're at 7.4%. A 40-60, more bonds than stock, maybe get a little bit older, maybe in your late 70s, early 80s. You're at 6.4% annualized. Still pretty decent. even bonds at 4.3, homes 4.2. And then we come to the average investor, Tony, down at 3.6. So a third of what the S&P 500 is at. And that should resonate with people out there, especially people out there when you have like old 401ks and you're tinkering around with them, or you're at work during this time and Joe next to you says, "Oh, Rob, I'm getting out of the market. I just saw this this big news thing on XYZ station, or I'm watching this on YouTube. Everything's going down, so Joe sells." And I'm like, "Oh man, if Joe's selling, I better sell." That's my advice. My advice is from the neighbor sitting in the cubicle next to me. Not strong advice, Tony. And you can see over time that the average investor just gets killed by the market.
Yep.
And that's where, when you're using professional money managers, when you're using financial planners like us, when you take the emotions out of it, we get the result that we're supposed to have. Even on a 60-40 portfolio, taking 60% of the risk versus 100 as the average investor, you're double. You're double. But I had a call the other day where clients like, I just came into this money and I'm going to take it. I'm going to put it all in a savings account, and I'm in my, now I know this client very well, a very good person, very afraid of the market, very afraid. And for that person, it suits it because they can't take it. They can't take when markets go down. They just can't stomach it. And my advice to people would be this is when markets are shaking like this, turn your phone off. Don't look at your account. Let it do what it's supposed to do. And when it gets on the other side, take a peek at it. And we have a proprietary system, Tony, called the Generational Vault. And the Generational Vault tracks, for our clients, it tracks all their investments. And I can tell you this, I can't see who logs on, Tony, but I can see how many people log on. And when the market is when this is happening to the market, that number is very, very low, very, very low. Like nobody wants to do it. I remember 2022. I had a client come in, and if you remember 2022, the market literally went down almost every single month, during the interest rate rising cycle. And I had a client come in with all her statements. She hadn't opened one all year. And she said, should I be opening these? I'm like, you might want to just wait like 3 or 4 months. I go, you're fine. And we have the reports and show where she's at. But sometimes not looking is the best thing. When you think of when you have a 401k and you're putting money into the 401k, you're not paying attention to it. And by not paying attention to it, and as long as it's invested, to your risk and to where you're supposed to be, you're going to look at that down the road, and that's going to be exactly where you need it. Like I've said on this show before, I have clients thinking that 2022 was worse than the financial crisis. And the reason is they were working during the financial crisis. So the money was just going in. They weren't paying attention to it. Now they're retired. Mm-hmm. They're looking at this stuff all the time, Tony. But back to the Generational Vault, when markets are going real good, there's a lot of logins to the Generational Vault. Everybody wants to see, oh my gosh, okay, what am I up? What am I up? So yeah, everybody's the same. Everybody's human. I'm human. I have accounts like anyone else. They go down like anyone else's, but I'm not like the average investor. I stay fully invested all the time. I believe in the market. And over time, you're looking here at a 20-year chart. We just showed you another 20-year chart. It works, so getting a professional to help you out with this, to take your emotions out of it, will save you so much money in the long run.
Yeah, I forget I've read the studies and the data shows that the average investor almost always, I forget that it's a high percentage, like 85% of the time, they will end up selling low and buying high.
For sure.
And which is the exact opposite of what they should do. Right. And we always hear like Warren Buffett, the Oracle of Omaha, considered one of the greatest investors, always a harp on that. He goes, when the market is down and you hear the sky is falling on the media, you maybe look at buying. Right. When the market gets record highs, maybe you do a readjustment at that time, but you never sell low and buy high. No. Unless you absolutely have to. And in retirement, especially during your working years. Now in retirement, you need a better balance, you need some more safety. And I know, Rob, that's what you help your clients do, and you're actively managing it. And you have the team like at Gradient Investments. We've had Binger on the show and the other people from Gradient Investments, the portfolio managers who are actively looking at it, and they're not letting their emotions get in the way. They're looking at your long-term goals and where you're at now and what is in your best interest. And so it is actively managed, but you don't have to actively watch it. They say a watched pot never boils. Well, we want the market to go up. So maybe just let it let it take its course.
And and like everything, like you're this is a well overdue market correction.
Yeah.
We make no statement. Like if you believe that markets just go up and that your account should just keep going up every month, you're sadly mistaken, and you will be disappointed, because they're
not how it works.
No, you need these pull-in companies that are way overvalued. You see companies like Palantir go from, $17 a year ago to $120. They're not worth that much more 1 year later, and they subsequently went down 40%. Like when you have a correction, it balances the boat. It gets the price to earnings back where they should be, and it's a good thing. And overall, it's a good thing. It's a necessary function to have an efficient market. Like it has to happen. It happens over and over again. And Tony, like the clients I have, I've been around for a decade and a half, so they've been through a lot of these. That's probably why I don't get a lot of calls. Even the newer clients, we obviously have new clients come on every month, and even them, if we provide enough knowledge, and if they're listening to this show and they're seeing what we send out to them, and they're sitting down with us, 2, 3, 4 times a year, depending on kind of what their situation, they're going to have enough information to make smart decisions. And panic is never going to enter the room. Emotions never enter the room, and when we do income planning, we're not taking it from a full equity portfolio. We have strategies that we can pull it from different areas. So, my final thought to everybody is, check the emotions at the door. Don't panic. But if you're out there and you're an individual investor and you don't really like what's going on, why don't you give us a call at 630-780-1099, or go right onto our site at apadvisorsgroup.com. Lots of information on there. You can book an appointment direct. Come in, and what we'll do for those people, and even if you're not an individual investor, maybe you want a second opinion because maybe whoever you're working with, maybe they're not looking at your stuff enough, or whatever the case. Bring that in. We can do a Morningstar review of that, Tony, a full fiduciary Morningstar review where we use a third party to say this is your risk, your return, your fees. Those are the three things that count in investing, compared to this is what we do. Apples to apples. Costs you nothing, to do that. This is a good time to do stuff like this, Tony. Like, especially if you're out there a little bit emotional, a little bit nervous, this is the time to maybe say, you know what, let me take a look at this stuff.
Yeah, that's huge. And, the sequence of returns risks that you've been talking about, and how emotional investing will kill your portfolio. So important to understand. You made a lot of great points today, Rob. I'm sure our listeners and viewers out there will want to talk about where they're at with you. So again, call 630-780-1099. That's 630-780-1099. And Rob, great show today. That does it for
Tony.
What's that?
Fantastic.
Yeah, it was a great
Enjoy
one.
the rest of that coffee too, by the way.
I am. I'm, yeah, I'm like a squirrel.
You're right.
So, all right. Thanks, everyone. That does it for today's episode of Ready, Aim, Retire.